Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. You know, in this episode, I want to get into mostly the bear case scenario that we talked about in our outlook. You know, we had both a positive bull case scenario and a bear case scenario. Much of it the analysis anchored on the changes in DC and how the economy, businesses, markets react to all that. But we've gotten, a lot of questions, especially about possible negative scenarios. So we kind of dedicated this episode to diving into some possible paths for those bear case for the bear case scenario. And, it's almost like how to think about it, maybe some investment ideas that could be helpful. And maybe I'll begin there just to say that if there was ever a time when like kind of the classic diversified portfolio could serve an investor well, this is probably one of those times. We're going to get into it, but you think about the anchor being having some equity exposure for growth, having some fixed income exposure for some stability, especially when our equity markets turn down. It's not always the case, but bonds tend to hold up better. And so that classic, what sometimes is called the 60-40 portfolio, obviously people tweak their weights accordingly to their specific needs and situations. But that idea of being diversified is really important. And so in some ways, when we get into the investment ideas, I'll just mention that it's really about building on that diversification. So anyway, let's jump into these various paths that we're seeing. And, I guess to start, and think of these as listed, I'm going to offer them in sort of the order of the most likely first, which tend to be the least impactful. And so we'll get into a couple that could well happen, if you will, and then a couple at the end that are really pretty severe tail risks, meaning we don't think they're really going to happen. I'll give you some ways that we're thinking about probabilities in that regard. But let's start anyway with the first one, what we've tagged kind of an erosion in animal spirits. So just think of it more as the confusion, right? There's poor communication sometimes. There's erratic shifts in policy as communication happens. And there's, of course, the risk of policy errors. But the worry about all that could erode sort of economy participant and market participant confidence. So an erosion in animal spirits, which is sort of that optimism that's sort of embedded in our system. If that starts to erode, that can easily turn sort of slow economic activity. It can certainly cause the market to move lower, maybe a 10% correction, maybe a bear market, which is defined as a 20% move. And what I would say is we still assign a fairly low probability. We think it's about a 15% chance of that scenario unfolding. And that's a place where obviously that traditional asset allocation approach could work well, but other strategies that hedge equities are a good consideration in that scenario as an incremental sort of means of diversification. Anyway, next up would be, let's say that something like that happens and we find ourselves in a U.S. recession, but we know there are already some troubles around the globe and maybe they sort of self-reinforce and we end up in a global recession, right? That obviously is also troublesome. That could, by the way, be influenced by aggressive tariffs or aggressive trade policy and sort of policy, quote unquote, mismanagement on a foreign policy basis. In any event, same thing. We could see a kind of a normal correction in the equity market or a bear market. Once again, we probably put that in a similar bucket, call it a 15% chance of that happening. And that same kind of approach being diversified to include categories that do better when equities are down or equities that are hedged, that kind of thing, are something to consider. Now, one thing that people worry about in the current environment is we've had sustained higher inflation, and it hasn't quite gotten back down to the Fed's 2% target. So while it's a little hard to imagine, meaning that, hey, if we end up in a recession, normally inflation falls, demand goes down, inflation falls, But if for some reason inflation doesn't fall, we would be in, that sustains for a while and the recession sustains for a while, we would be in what's called a stagflation environment, right? So recession plus inflation. And if it's sustained, this path that we've tagged it as sustained stagflation, that could be more troubling to investors. And so in that particular case, you can imagine people just getting a bit more spooked, and that leading to a more severe equity reaction, maybe a more severe bear market. Now, as it relates to investing, that idea of being diversified is good, but in that scenario, inflation protection type securities, so Treasury inflation protection securities, TIPS, or real assets, which tends to do decently sometimes in an inflationary environment, or even if rates are kind of going higher in this particular scenario, maybe floating rate bonds. So those are just different investment ideas that you can consider in a sustained stagflation environment. And so those all, anyway, by the way, we put about a 5% chance of that happening. We don't really see it happening because we believe if we see a recession, things slow down, inflation will cool. So we're not overly worried about that. In any event, let's get to a couple of the more dramatic scenarios. So first up would be really around our debt. We've been talking about fiscal transition, the current fiscal trajectory, and the buildup of debt, and kind of that being kind of mismanagement. So think of this as being tagged U.S. fiscal trajectory and debt mismanagement. That path, basically, we really feel strongly that the government needs to rein that in. And to the degree we see continued sustained deficits year after year, and the buildup of the debt and the buildup of the cost of our debt, and think of that as all happening much faster than economic growth, for example. Basically, we are at a state down the road where the U.S. dollar as a reserve currency, as well as, or in addition, or instead, U.S. Debt having a loss of confidence, meaning investor losing confidence in investing in U.S. debt. And that, we don't like to use the word economic or phrase economic depression often, but, we do have to worry about those extreme scenarios. We have to be maybe a better word is mindful of their possibility. And obviously that would be a difficult environment for stocks if that were to unfold. Anyway, that all unfolding, with the debt trajectory, think of the probability in our heads as being less than, 2 to 3%. So it's really, really low chances of this happening, partly because as things really do trouble starts to show, then government tends to shift its approach, and that would be a catalyst for, improving in terms of spending and all that. And so anyway, something to be mindful of, but we're not overly worried about it. Finally, the last one really comes, honestly, from investors and clients that I've been talking to, the people who are more worried about the shifts in D.C. So the fear, the worry is that there's a lot of change that's going on, that the new administration's pushing the edge, that could lead us to essentially a constitutional crisis where, certain branches of government, to say it more generally, are overstepping their boundaries, and maybe the court system gets skunked up or doesn't resolve it, right? So we tend to anchor in the checks and balances of our government and what's happening there, but there are people who are worried that could break down. And, so what might happen if that occurs? Well, we could see a partial shutdown of the government. We could see, more severe sort of interaction within the government, or of course, this kind of thing could lead to civil unrest. All of these things potentially disrupting our economy and therefore having an impact on the markets. And so once again, if that were actually to unfold in some way that is really problematic, that could really have a severe impact on the economy and certainly an impact on the market. But, note that we really see this as a much, much lower probability scenario. We really feel strongly in and have confidence in our checks and balances as it relates to the way the government operates. In any event, when it comes to investing, in these more extreme scenarios, you want to be talking to your financial advisor about investments that might do well in the more severe negative environments. The classic is gold or precious metals. And again, these are things you should talk to your financial advisor about. But there are other hard assets or things potentially like infrastructure investments. Just think of it as an opportunity, essentially, if you're worried about this, to have a conversation with your financial advisor who will have good information about different kinds of things to consider to sort of hedge out risk and maybe create, honestly, some upside opportunity for sort of these less commonly used investment categories, but that tend to do well in these more negative environments. So again, I think the overall takeaway for sure is to, this is a topic and an environment where it's really, really, really helpful to engage your financial advisor and basically talk through the issues. So listen, thanks so much for listening to this episode, kind of a downer to talk about bear case scenarios, our paths on our bear case scenario, but we felt compelled to do it. We've had a number of clients asking, and we know that there's a subset of investors out there that are a little bit concerned while others are optimistic. So we just wanted to spend some time in this episode framing out the bear case. Hey, thanks so much.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.